Welcome back to episode 2 of the Finance Series, viewers. Today we're going to be talking about the game, the investing game, I mean. And I think, from what I've learned so far, it might be rigged. Our parents grew up in a world where just your salary could buy you a house and it's all fun and games after that. But now, times have changed. Now, your salary can buy you maybe a small apartment in New York, might just be a tent, you never know. And buying an actual house needs 30 times your yearly income. That's too much money, right? And every person on Instagram is trying to sell you a get rich quick course, right? This is not a 50-cent album, it's not gonna work, right? It feels like we're lab rats in a system designed to keep us spending and we're not saving any real money. To help us fix this extremely complex world, we have Ashraf Calcuttawalla. He has over 2 decades of experience in all areas of risk management: credit, liquidity, operational, climate risk, all of that. And he's worked in a multitude of banks as well, Citibank, just to name a few. It's great to have you here, sir.
Thank you, Aro. Thanks a lot.
I want to clear up some misconceptions people might have in the audience. Many people think investing means like frequent action and always ensuring that you're on top of things. But tell us a little bit of how inactivity can actually help us build our money faster than constant pestering of the money actually would.
So I would say yes, there are a lot of misconceptions about investing.
Right.
What is required for investing is a mindset of sometimes you need to be calm and composed.
Right.
Obviously, that is easier said than done. You have to have systems for that. You need to have discipline for that. And you need to cultivate habit of investing. Now, what do I mean by that? It means whatever you are, let's say, if you are having any pocket money or if you're generating any money, any revenue, you need to make a rule of thumb that, okay, at least 20% or 30% of whatever money I'm getting in, I should save it aside for a rainy day. If you have that basic system in place, sometimes that helps you do wonders. So what is it? It is about a very boring and simple rule which you need to have. But these boring rules take you a long way. So what I would say is investing is a mindset. And that is what has actually even worked for me, which is what I also practice it for myself as well.
Right.
That's what I do. At almost 25-30% of my income, you put it aside, and then what you do is you make it in form of buckets. You think in terms of buckets. So let's say one is your minimum, like a cash deposit, which is like a fixed deposit you can call. That could be one bucket. The other bucket could be for growth. So where you would do a little high risk investments. And the third bucket, what I call is a fun bucket or an adventure bucket, where you may even think of investing in crypto. But you have discipline for that. You have rules for that. And these are the very basic, simple rules and systems which you create. This helps you to not get carried away via what you call as FOMO. Sometimes there are hype about certain investments. So if you have the simple rules, it helps you not to get carried away.
Right. No, I think that's great. We built up on this in episode 1 as well, where we talked about the golden ratio and we talked about the 50-30-20 split and the 40-40-20 split. So I think that's great. Coming to the actual investment part of all of this, what's good investment and what's bad investment? But in that sense, I mean, good investment, what kind of stuff would one do to have a good investment mindset, and what's actually a bad thing? Like, for example, from what I can understand, greed would be a bad thing, and FOMO would also be a bad thing. What are some of the good qualities of a good investor?
So as I said, a good investment is driven primarily by systems and by habits. And you have those simple rules, which sometimes you may call it, as I said, these are boring rules. But boring over a period of time gives exceptional results.
Right.
It becomes brilliant, or if you're practicing those boring rules for 5 years. After 5 years, it gives you brilliant results. So keeping those rules in mind, and let's talk about an example. So what you're asking me is what specific modes of investment should we do?
Yeah.
So you start with a simple fixed deposit. Now, fixed deposit is what you keep with the bank. Typically, the banks give return which are slightly above the inflation. Inflation is something where every year the value of money changes or goes down, like just as per the economic scenario. So FD is a very simple product where the banks keep money for you, and your principal is protected for most of the time, unless the bank runs out. And then you have capital markets, which is the equities, bonds. So that is another form of investment. So as you said, 50, 30, 20. So maybe 50% of that money you keep it in of your investment, keep in fixed deposits. 30% you try to do equity investments. And obviously, your equity investments is a big pool. It's a global environment. So you start with index, not investing in any specific stocks. You start with index funds. Or what you could do is you could invest in shares which you're using on a daily basis. For example, I'm using Google, I'm using Amazon, I'm using Microsoft. So you even you buy one or two shares in that portfolio. Let's say I am buying Microsoft shares. What I would do, I would try to track how the company is performing, what is making the share price go up and down, what is moving the market. So even if I'm investing just one share, which is of $200, I would track of how the market is moving, how the geopolitical, how the global environment is impacting the share price performance. And yes, you have a lot of simulators where you can simulate and you can see how your portfolio is working. But let me tell you, simulators are like flight simulators. They are not real flights. So no simulator can give you an emotion of when the market goes down by 20%, how will you react? How will your emotions be? So you need to try different things. And as I said, the 10-20% of the bucket you should keep for experimental stuff. This is where you will see how you are behaving when the market changes. When the market goes up, if the market is going up suddenly on some news on that 20% on adventurous stuff, would you try to put all your 50% into that 20%? How are you balancing yourself? How are you keeping your emotions in check? It will tell you about yourself, how you behave.
Okay, makes sense, yeah.
Yeah.
So I think building up from what we learned about at the start, right, when you started.
On that, I just wanted to add one more point. Borrowing is good only when you borrow for assets that help you grow, but not for something which is an expenditure and it is not helping you buy an asset which will help you generate revenue. Otherwise, freedom isn't doing everything now. It is a peace of mind. So you do it for the long term. You want to take debt, go ahead and take debt. But ensure that you buy an asset which gives you a return.
I think that's beautiful. Investments. Time is often said as to be the most important virtue in an investor's whole skill set, right? So why does time matter more than skill for at least my generation early on when you're 16, 17? Why does time matter way more than skill?
So very pertinent question. For a Gen Z, timing is everything. And starting early on, investing is not about generating returns. It is about cultivating habits.
Right.
It is about knowing your nature. How would you manage your investments? Any Gen Z who is spending should also do investing. If you are spending, why are you not doing investing? So the moment a Gen Z understands the dynamics of money and has started to spend, he should also have a mindset of investing. So that is where, and early on, it's about starting early on. Investing is starting about early on. The moment you start early on, you will beat any smart investor.
Right.
Early on, results will be extraordinary, and any smart investor, you could beat that.
So before you were talking about buckets, right, and how you can put all of your money into different categories, I think that really ring a bell with diversification in your assets, in your investment portfolio. So why does that diversification matter way more than just putting all of your money into one stock or maybe two stock, which you know are gonna go up, but then you can actually split it into multiple stocks, but some of them might go up, some of them might go down.
Yeah, so diversification is one aspect, as you said, and everybody knows. Don't put all your eggs in one basket.
Right, right. of
That
course.
is a very simple
Way
cue,
of
which
explanation.
even I teach my 7-year-old
Right,
child.
right.
So, but what is the opposite of diversification?
Putting all of your eggs in one basket.
Concentration,
Right, yeah.
right? So, concentration can help you. Concentration is about emotion.
Right.
Do you want to be high on emotion? Do you want to be high on concentration? Or you want a balanced approach?
Right. Okay.
So this is what you need to choose. And obviously, a sane mind will always tell you to have a balanced approach and results which you can control. You don't want to put it on luck. So if you are concentrating on one share or one crypto, which is today the hype is all around that, you are leaving it to a chance and luck,
Right, right.
and then you're just hoping, and you have got emotion about it.
And that builds lots of risk.
So do you want to get there? You may want to do that on an experimental basis. So maybe 10% of whatever you're doing, you do that. And that's what I said, you will find about your nature. How are you
Right.
reacting and
Right,
how are you
right,
managing? So even if you lose the money over there, it's okay. You move on and you have learned. And this is a lesson which will be which you are not paying too much of it. You're not paying with too much of stress. It's
Right, fair enough.
controllable.
Okay.
It's manageable.
Hear that memories, they're permanent and money can always come back and experiences are over all the costs and stuff like that. So, like taking loans for concerts and taking loans for stuff like those experiences, trips to go or whatever, are those actually stuff which is worthwhile? Or are we just like borrowing from our future? And like you said, are we going to be sad at 28 if we're happy at 18 with these trips?
In
Are we going to
fact,
fall into all these debt traps?
if you get into the FOMO trap, you will end up doing some of these mistakes.
Right, okay.
And I think everybody should do some of these mistakes.
Oh, okay.
That will help you build your character. Because unless you do mistakes, unless you fail through certain aspects, you will have to go through that cycle.
Okay.
That will help you build character. And it's always good to do small mistakes.
Right, okay.
Small mistakes will give you bigger lessons because the fundamentals are the same. And people do take sometimes loans or EMIs, buy now, pay later for these concerts. So what I would say is debt for experiences isn't freedom. It is actually delayed anxiety.
Oh, okay.
Because once those EMIs come on your show up on your income statement, you will have to live broke for few days or few months to pay that up.
Right, okay.
So if you are willing to sacrifice that, if you are willing to go through that anxiety, might as well do it. And that is well you will realize what you have done. But nobody can preach you or teach you unless you go through that grind.
So making the mistakes is very like important, and
It is
learning from
important.
those mistakes.
So
is the
do
best thing.
mistakes, commit mistakes, but small.
Okay, okay.
Nothing that puts you out of your college admission, that you have taken your entire college admission fees and went to Las Vegas.
Right.
Don't do that.
That's not a good idea.
Yeah.
Okay. So as you said, making mistakes is an important part of this, and you have a multitude of experience, right? You've been in this for upwards of 3 decades now. So looking back onto your teen self, I'm sure you must have made these mistakes. What would you say, and what would you give the advice to 30 years ago?
Yes, that's what I told. My advice would specifically be commit mistakes, because everybody have gone through that. Even I could recall, even I have done similar mistakes.
Right.
In fact, I had fully maxed out my credit cards
Oh.
to go on a honeymoon trip to Europe. Was it worth it? Maybe yes. But yeah, you have to do some, and on another occasion, I can count where from investing, I went into speculation and I had bet my almost 3 to 4 months of my salary on that. And I ended up losing 1 month of my salary.
Oh no.
So you will do those mistakes,
Uh-huh.
and but that is a learning curve which you need to go through.
Right. Okay.
The only advice what I would give you is do it in a controlled fashion and don't go overboard, like
Okay.
how I went.
Okay. Okay. So I think that ties into beautifully what my next question would be, and that's learning. How can people my age actually learn to not make those mistakes? I know you said that the mistakes are very important, but just to ensure that just to ensure that when you're stepping into the market, you have the like the most amount of knowledge you can, and you make the least amount of mistakes that you can. So maybe courses, maybe some internships, experiences, something like that.
So the good thing about your generation is there is a lot of awareness. There is a lot of tools available. A lot of simulators are available. You have a lot of AI tools available to tell you what mistakes or what how should you start as a beginner. So if you give a simple prompt to ChatGPT, it will tell you a plan. It will tell you a good plan of how to follow a plan. So those awareness, those tools, those intelligence we didn't have. So we have done trial and error, and this is how we have come up. But for you, for your generation, you have a lot of tools, amplitude of tools available. So I think you should use those tools. And of course, another important thing is you should have mentors in life. So
Right.
you, whatever field you are choosing, find a set of mentors who are experienced in those areas. Those mentors will tell you the mistakes what they have done and how you should try to avoid them.
Right. Okay.
Yeah.
Makes sense. Yeah. You can pause. Go.
In fact, on that point, I just remembered one quote.
Right.
At the age of 18, you're not trying to get rich. As you're trying to become the person who won't panic at the age of 28 that, okay, you have lost all the time.
That's a very good quote. Yeah, I must say.
Okay,
Okay,
let's move on.
So I think we can move on to the bit more of a technical aspect, get into the depths of it now. How do ETFs and mutual funds actually work, and how do they fit into the long-term framework? As you said, that you're not trying to get rich at 18, you're trying to be not sorry at 28. That's a 10-year span, right? So how do all these ETFs and mutual funds actually fit into the long-term framework of all the investing thing?
So let me just decipher what is mutual fund.
Of course, yeah.
Mutual fund is, so let's say if you want to go and invest in equity markets,
Right.
or there are debt markets as well, there are commodities as well. So do you want to take that decision? If you are very confused about all this, what you do is you leave it to a professional investor or a professional fund house. So what do the fund house do? They collect money from all the investors. So all the retail investors pool in money to that mutual fund or to that fund. And there is a professional fund manager who manages your all the money of all the investors.
Right, right.
So in brief, that is what a mutual fund is. It's a professionally driven fund house, and those every portfolio manager is tracked, traded, and they are tracked in the market how they are performing, and they are ranked, and that's how they build their competitive and they generate returns for the investors.
Right. So just show how good of a rank you are, so people would like to hire you and stuff like that.
Yeah. So if you're confused about where to invest, leave it to the professionals,
Right,
as they say.
right. Okay.
So you put it to a professional mutual fund.
So we talked about how, if it's too risky for you, you should leave it to a professional, right? But what if I don't want to do that? What if I actually want to invest by myself, right? And I want to avoid all the mistakes other people are making. So as markets change, even the best investors must make some mistakes, right? So what can I do to avoid those mistakes?
So as we said, discipline is the key.
Right.
So what you need to do is, first of all, you can also experiment, as I said, with small sum of
Right.
money. So if you want to know what is equity shares, you go and invest one share, or you go and let's say you want to learn about commodity, you want to learn about how gold is, you can go and buy $100 of gold from an open market and keep it with you, and then watch how the gold price is changing. Follow the market. What is pushing the gold price up? What is pushing the gold price down? This will help you to understand that, okay, the gold which I am holding, even though it is $100, it would today it is $110.
Right.
And then you can go and tell your parents, hey, I earned $10. And it will also show you how much time spent have it gone to make that $10.
Okay, makes sense. Yeah, and this is all tailored towards the Gen Z audience, and I think one of the biggest things the Gen Z struggle with is pressure from social media and just general influence on social media, right? So, how do you think social media is influencing the way we, as a Gen Z, as my age people, are investing their money?
Well, social media is big. Thankfully, we didn't have that problem. But the problem of comparison, the problem of comparing people and status has been through ages. It has been across ages. People, there have been always comparisons of rich versus poor. But now it is very evident. And now there is a lot of fakeness around it.
Okay.
So what we see in social media is just an image of, let's say, filled with all the luxury. But behind those cameras, sometimes it is hard work, sometimes it is fake news.
Right.
So it could be either way. We don't know what is driving that.
Right.
But should that impact my behavior? I need to have my own plan. I need to have my own mindset and not get carried away by what I'm seeing on social media. You need to have your own systems, own habits, and own plan. And of course, as a Gen Z, you should always try to think outside the box and try to do adventure stuff, but keep it to a controllable aspect that adventure stuff doesn't wash out the entire 100% of your wealth, or it puts you in a lot of anxiety and stress.
Right, fair enough. I think social media, one of the biggest things that's done is just like fuel cryptocurrencies, right? I mean, there's lots of examples. Some cryptocurrencies, they just start because of memes, right? They become meme coins and they go to a very, very high price, and then they're rug pulled and they come crashing down. So I think that draws the question on crypto, right? In this day and age with social media, we talked about how risky it is. But why is crypto in general also very risky? And to avoid that risk, how can we understand crypto and work with crypto in a less risky way to ensure that we are in that space and we are still making money?
So yes, you can experiment with crypto and try to understand what is moving the markets.
Right.
But what we have seen is even the professional investors stay away from crypto, and they understand very little of what is driving the crypto markets.
Right.
So as a Gen Z, you should experiment with different stuff, but have it in a controlled fashion. And what is crypto? Crypto is a form of medium of cash. So today it's a currency. So today you have dollar, today you have Indian rupees, or today you have euro. Crypto is a medium of exchange.
Right.
Now, you just tell me, if one medium of exchange is fluctuating so high, is that a reliable medium of exchange?
Definitely not.
So you need to ask those basic questions and challenge the fundamentals.
Right.
It will help you to drive and be on the straight path.
And I think that ties beautifully into all the paper trading and stuff, right? So experimenting comes into simulators, as you talked about, the flight simulators and stuff like that as well. So what do you think these simulators, the paper trading simulators, are actually doing well? And what do you think they falter in?
So this is a very interesting question, and there are a lot of mysteries around it and a lot of stories around it.
Right.
Each crypto has its own story. Some of them are good, some of them are not so good. We have seen a lot of stories around crypto which has crashed. So something which has a more ratio of crashing you have to be careful about it. And I would advise stay away and be a bit disciplined about it.
Markets tend to change all the time. They're going up and they're going down, right? And yet, most traders, even though they can predict all of that, still manage to underperform. What behavioral mistakes are they making? Is it greed? Is it not keeping track on what the geopolitical scenes are? And how can people avoid making losses in all these predictive markets and even in positive markets?
Traders and trading is a lot of stress because you are continuously in front of the screen all the time. So yes, traders do make big money, but sometimes what we see is a lot of traders, even if the market are rising, they fall really bad.
Right.
Why is that? What we have seen, the trend is there are three main killers of this. One is overconfidence. So when you have made one big bet and you have made huge money, you get into an overconfidence mode. And then you ignore all the fundamentals and go overboard. That is one. Second is greed. You get carried away and you don't follow the habits, the discipline that we have discussed. And finally, third is ignoring the reality and ignoring the facts, which is called, in behavioral finance, it is called confirmation bias. So I'm only looking for news which confirms my trade or confirms my belief.
So you're ignoring everything.
I'm ignoring the rest of the stuff.
That does not sound right.
So those are the points which sometimes the traders get carried away. And there could be novice traders, but even professional traders get emotional and get carried away when they don't follow the discipline. They buy into the hype and sell the fear. And that's what they call strategy.
Okay.